Welcome to Chapter 1, Understanding Economic Systems and Business. This chapter introduces some of the basic business and economic concepts that we will use throughout the rest of this course. We will look at what businesses do, the resources they need, the economic environment in which they operate, and how concepts such as inflation, employment, supply and demand, and competition affect business decisions. There are several learning outcomes listed for this chapter. Don't let the number overwhelm you. The major ideas I want you to focus on are how businesses operate within the economy, the differences among major economic systems, how we measure the health of the economy, how government economic policy works, and how supply, demand, and competition affect business and consumers. Those concepts will also be important on your Chapter 1 quiz and Exam 1. Business provides goods or services to customers with the goal of earning a profit. Revenue is the money that's earned from selling those goods or services. Costs are the expenses required to operate the business, and profit is what remains after those costs are deducted from revenue. A not-for-profit organization is different because their primary purpose is accomplishing a mission rather than generating a profit for the owners. Businesses also depend upon what we call the factors of production. So OpenStax identifies natural resources, labor, capital, entrepreneurship, and knowledge. Natural resources include things such as land, water, minerals, and raw materials. Labor is the human contribution to production. Capital refers to productive resources such as equipment, tools, machinery, and buildings. An entrepreneur brings those resources together, accepts the risk, and attempts to create something of value. Knowledge represents the skills, the information, the expertise of the workforce. One important distinction: in economics, capital does not simply mean money. Think of capital primarily as the productive assets used to produce and distribute goods and services. Now, businesses don't operate in isolation. Managers make decisions inside an environment that is constantly changing. The internal environment includes people and activities over which the business has greater control, such as managers, workers, entrepreneurs, and many day-to-day decisions. The external environment contains forces that the company usually cannot control. So those external forces can still dramatically affect whether a business succeeds or fails. This diagram shows 7 major parts of the external business environment. These are economic, political and legal, demographic, social, competitive, global, and technological forces. For example, inflation and interest rates are economic forces. New regulations are political and legal forces. Changes in the age or composition of the population, those are demographic forces. Consumer attitudes and lifestyles are social forces. New competitors affect the competitive environment. International events affect the global environment. And developments such as artificial intelligence or automation affect the technological environment. Managers cannot control most of these things, but they must recognize and adapt to them. Economics is the study of how society uses scarce resources to produce and distribute goods and services. Every country has an economic system that helps determine 3 basic questions: what will be produced, how will it be produced, and who will receive what is produced. The major systems discussed in this chapter are going to be capitalism, communism, socialism, and mixed economies. Also remember the difference between macroeconomics and microeconomics. Macroeconomics looks at the economy as a whole. So these are things such as national employment or unemployment, inflation, and GDP. Microeconomics looks at individual consumers, businesses, and industries. This table compares the major economic systems discussed in this chapter. Capitalism again, communism, socialism, and mixed economies. Let's start with capitalism, sometimes called the private enterprise system. Capitalism emphasizes private ownership of businesses, competition, freedom of choice, and the opportunity for owners to earn and keep their profits. At the other extreme of that is communism, where the government owns virtually all resources and central planners make most major economic decisions. Socialism falls somewhere between those two. So in socialism, the government typically owns or at least strongly controls basic industries, while private ownership may still exist in other parts of the economy. Now that one's going to be close to a mixed economy. A mixed economy combines characteristics of more than one system. In reality, most modern economies are mixed rather than fitting perfectly into only one category. Now this part of the table shows another important difference between, or difference among, economic systems, and that is who makes business decisions and how much freedom managers have. Under capitalism, businesses are generally managed by their owners or professional managers with relatively little government interference. Communist systems, however, rely much more heavily on centralized government planning, which gives individual businesses less flexibility. Socialist systems involve significant government planning and regulation in certain industries while allowing more private decision making elsewhere. Mixed economies combine these approaches. Private businesses may operate much like capitalist businesses, while government-owned or highly regulated organizations may operate more like those found in socialist systems. The easiest way to think about these systems is as positions along a continuum rather than completely separate boxes. This diagram illustrates how households, businesses, and government interact. Households provide businesses with resources such as labor and receive income in return. Businesses use those resources to produce goods and services, and consumers use their income to purchase those products. Government also participates by collecting taxes and providing public goods and services. The important idea isn't memorizing every arrow on this diagram. It is recognizing that households, businesses, and government are interconnected. A significant change affecting one part of the economy can eventually affect the others. Macroeconomics helps us to evaluate the health of the overall economy. One important measurement is going to be gross domestic product, or GDP, which represents the total market value of final goods and services produced within a country's borders during a given time period. So when economic activity declines significantly, the economy can enter into what's called a recession. Another goal is full employment. Full employment does not mean that literally every person has a job. Some unemployment always exists as people change jobs or enter the workforce or work in seasonal industries. There's four types that you should recognize. First is frictional unemployment. This occurs when someone is temporarily between jobs or they're entering the workforce. The next is structural unemployment. This occurs when workers' skills are no longer or their skills no longer match the available jobs. Third is cyclical unemployment. This results from an economic downturn or a recession. And then lastly is seasonal unemployment. This occurs because certain jobs are available only during particular seasons. Another important measure is inflation. Inflation is a general increase in prices, which reduces purchasing power. You have demand pull inflation. This happens when demand grows faster than the available supply. Another is cost push inflation. This occurs when increased production costs, such as wages, fuel, or raw materials, cause businesses to raise their prices. Inflation is commonly measured using the Consumer Price Index, or CPI, and the Producer Price Index, or the PPI. Government policymakers try to promote economic growth, employment, and price stability using two major tools: monetary policy and fiscal policy. Students often confuse these, so remember the distinction here. So monetary policy is primarily associated with the Federal Reserve and the money supply and interest rates. Fiscal policy involves government taxation and spending. Those are two different tools. This slide illustrates the government's fiscal side of the economy. So the federal government receives revenue primarily through taxes and then uses that money to pay for government programs and services. Now, when the government is spending when their spending is greater than the amount collected in revenue or taxes, the result is that we have a budget deficit. When deficits accumulate over time, they contribute to our national debt. Remember, the taxation and government spending are part of fiscal policy, not monetary policy. You'll see this on the exam and the quiz. The other major economic policy tool is the monetary policy. This is primarily carried out by, again, the Federal Reserve, or what's known as the Fed. The Fed is the central banking system of the United States, and it influences the economy by affecting the money supply and interest rates. With an expansionary monetary policy, the Fed increases the availability of money and encourages borrowing and economic activity. With a contractionary monetary policy, the Fed restricts the money supply or raises interest rates in an effort to slow economic activity and reduce inflation. A simple way to remember the distinction is this: monetary policy deals with money and interest rates, fiscal policy deals with taxes and government spending. So now we move from macroeconomics to microeconomics. We mentioned this before, but demand is the quantity of a product that consumers are willing to buy at different prices. Generally, as price increases, quantity demand decreases. Supply is the quantity that businesses are willing to offer at different prices. Generally, as price increases, businesses are willing to supply more. When supply and demand meet, we reach the equilibrium price and quantity. So this graph shows the relationship between price on the left and quantity demanded at the bottom. In general, consumers buy less of a product when the price rises, and they buy more of it when the price falls. This is why the demand curve slopes downward. One important distinction is that when the product's own price changes, we usually move from one point to another along that same demand curve. This is different from a change in demand itself, which we will see in a few slides. The supply curve works in the opposite direction. So as the price businesses can receive for a product increases, producers generally become willing to produce and sell more of it. That is why the supply curve slopes upward. At lower prices, producers generally just offer less. So remember the basic pattern. Price and quantity demanded move in opposite directions, while price and quantity supplied generally move in the same direction. So when we place the supply and the demand curves on the same graph, as you see here, they intersect. That intersection is the equilibrium point. At equilibrium, the quantity consumers want to buy equals the quantity that businesses want to sell. If the market price is above equilibrium, then businesses may have excess inventory because they're supplying more than the consumer wants to purchase. If the price is below equilibrium, Customers may want more than businesses are willing to provide. Market adjustments tend to move the price toward equilibrium. So this slide introduces an important distinction. So changing the price of the product itself generally causes movement along the existing demand curve. However, something other than the product's own price can cause the entire demand curve to shift. For example, demand may increase because consumer income rises, or preferences change. Maybe more buyers enter the market, or consumers expect prices to rise in the future. So when demand increases, the curve shifts to the right. When demand decreases, it's going to shift to the left. Another table here, but this one summarizes factors that can shift the demand or the supply curve. So again, demand can shift because of factors such as consumer income, preferences, expectation, the number of buyers, and the price of related products. Supply can change because of factors such as production costs, technology, taxes, the number of suppliers, and expectations. The important thing to remember is that these factors change more than just the quantity bought or sold at a particular price. They can change how much consumers want to buy or businesses want to supply at many different prices. Economists classify markets according to their market structure, meaning the competitive characteristic of the market. There are four major structures: perfect competition, monopolistic competition, oligopoly, and monopoly. Perfect competition contains many sellers offering essentially similar products with relatively easy entry into the market. Because there's so many competitors, individual businesses have very little control over the price. Monopolistic competition also contains many sellers, but businesses try to differentiate their products or services from competitors. The other two structures have considerably fewer competitors. So an oligopoly is dominated by only a few major firms. Entry into the market is difficult, and the actions of one major company often influence the decisions of its competitors. A pure monopoly exists when a single seller controls the market and substantial barriers prevent competitors from entering. When identifying market structures, focus on these three questions. How many sellers are there? How different are their products? And how difficult is it for a new competitor to enter into the market? This slide gives us a chance to pull those four structures together. So think of them as moving along a spectrum. At one end, you have perfect competition. Perfect competition has many firms and very little individual pricing power. Monopolistic competition has many firms as well, but their products are differentiated. An oligopoly has only a few dominant competitors, and at the other end, a monopoly has only one provider and significant barriers to competition. On your assessments, you may be given a business scenario rather than simply being asked for a definition. So look for clues about the number of competitors, product differences, barrier to entry, and control over price when answering those questions. The business environment never remains static. Demographic changes, technology, global competition, energy demands, and changes in the workforce continually create new challenges as well as new opportunities. The major takeaway from Chapter 1 is that business decisions are inseparable from the economic environment. So before completing the quiz and preparing for Exam 1, make sure that you can explain these: the factors of production, capitalism, socialism, communism, and mixed economies, macroeconomics versus microeconomics, GDP and the recession, the four types of unemployment, demand pull versus cost push inflation, monetary versus fiscal policy, supply, demand, and equilibrium, and the four major market structures. If you understand these concepts rather, and you can recognize them when they appear in a business scenario, you have the major material from chapter